Welcome back to Gold Rush Reporter, your go-to source for the latest insights and updates in the silver and gold markets. Today, we're diving straight into a critical development. The silver price has dropped precipitously. I say it again for emphasis. The price of silver has fallen significantly, and everyone is asking the same question. Has the bull run ended? And what exactly is happening in the markets right now? Let's unpack it. First, a quick note. If you want to secure your gold and silver quickly, SD Bullion is an excellent option. Visit sdbullion.com, new, to purchase instantly. Physical metal is always the safest hedge against volatile markets, and now, more than ever, you'll want to have a piece of the action in your hands. Now, to the core of today's story. Silver is currently trading at $72.78 per ounce, down about 7 or roughly 9% in just a single session. That is a sharp decline, and it has many investors and stackers feeling uneasy. After reaching an all-time high of $83.35 last night, the price dipped to $75 per ounce as Asian markets opened, followed by further drops to around $71 per ounce. This volatility is not typical in such a short time span, and it highlights the pressure the silver market is facing right now. Gold is following a similar trend, though the decline is less severe. Currently priced at 4,356, gold has lost about 182s or 4% in a day. Platinum, on the other hand, has experienced a sharper drop, losing 13.5% and currently sitting at $2,134 per ounce. These numbers indicate that silver, with its 9% drop, is under the most acute pressure in relative terms, reflecting the significant market volatility we're witnessing today. One of the driving factors behind this move is the rising gold to silver ratio. With silver declining faster than gold, this ratio has ticked higher, though it remains below 60. From an investment perspective, this still makes gold the safer choice relative to silver at the moment. Nevertheless, for those who want exposure to silver, today presents both risk and opportunity. Risk because of the sudden drop, and opportunity because physical silver remains in high demand globally. Another key element to consider is the futures market. The silver futures price is currently at $71.56, below spot prices, which are trading around $72.40. This backwardation indicates a unique dynamic. Spot prices are stronger than futures, reflecting physical demand that is not matched by paper contracts. In other words, silver's physical market is showing real strength, even as the paper market experiences declines. Comparing this with Shanghai, silver continues to trade at a premium over US and London markets. This shows the decoupling between the global paper markets and physical silver. Even when prices drop sharply in the West, buyers in the East continue to bid aggressively, highlighting the global demand that underpins silver's intrinsic value. Finally, margin hikes at COMEX have exacerbated the decline. The recent increase to silver margins, the largest since December 12th, targeted leveraged longs and caused a sharp liquidation. Historically, these moves have temporarily crushed prices before allowing a rebound, but the magnitude of today's decline makes it difficult to predict whether silver will recover immediately. Stay tuned, because the events we're seeing today are part of a larger trend in silver. The volatility has not ended, and this is exactly the type of market behavior that separates weak hands from committed stackers. Physical silver is becoming increasingly difficult to procure, and opportunities exist for those willing to act strategically. Silver's recent plunge is shaking the market, but it's crucial to look past the panic and understand what's driving this volatility. The sharp drop to $72.78 per ounce has traders and stackers questioning whether the bull run is over, or if this is merely a shakeout before higher prices resume. The first thing to note is that silver's price movements today are being influenced heavily by margin requirements on futures contracts. When the COMEX increases margins, leveraged positions, particularly long positions, are forced to liquidate rapidly, creating sudden downward spikes. This isn't the same as a market correction caused by fundamental weakness. Physical silver remains scarce, and demand continues to outpace supply globally. Asian buyers, particularly in China and India, are still bidding aggressively, often paying premiums above Western market prices. While the US screen may show $72, $73 per ounce, Shanghai is trading closer to $82. This disconnect is not random. It highlights the decoupling of the paper market from actual physical silver. The paper market allows for rapid, leveraged speculation, but it does not reflect the scarcity of physical metal that people are scrambling to acquire. The timing of the COMEX margin hikes is no coincidence. By raising margins just days before the holiday liquidity period, they effectively trigger forced liquidations in the West, while supply in Asia remains robust. This results in a temporary drop in US prices, while the actual demand for silver continues to grow. For stackers, this creates an opportunity. Despite the paper market showing weakness, the physical market is tightening. Retail dealers are reporting 3 to 4 week delays in delivery, and some US wholesalers are running out of silver entirely. It's also important to note that this volatility separates weak hands from committed stackers. Speculators who were riding leveraged positions may panic and sell at a loss, while long-term holders see a chance to accumulate more metal at temporarily lower prices. This dynamic reinforces the structural scarcity in the physical market. Real silver, coins, bars, and private stockpiles is increasingly difficult to procure, and anyone waiting for a better entry point may find their options shrinking. From a technical standpoint, silver's rapid decline has reset some short-term indicators, but the long-term fundamentals remain unchanged. Supply constraints, rising industrial demand, and central bank interest in precious metals all support a bullish outlook. Even though prices have dipped sharply, this is not necessarily the end of the bull run. The recent spike to all-time highs and subsequent correction mirrors historical patterns, such as the events of January-March 1980, when silver's price swung dramatically before stabilizing at a higher baseline. Another factor to consider is the global arbitrage window. With export controls looming in several countries, physical silver is moving quickly, and Western markets may struggle to align with the East. This creates a premium for tangible silver outside the US, making the dip a temporary dislocation rather than a true market top. For investors, understanding this global context is crucial. Price charts on local exchanges do not tell the whole story. Physical availability, international flows, and market mechanics are just as important. In summary, today's decline is extreme but largely technical, driven by margin adjustments and paper market dynamics rather than a collapse in underlying demand. Silver remains scarce, global buyers are active, and long-term fundamentals continue to favor higher prices. For committed stackers, this temporary drop is a chance to acquire more physical metal at a relative discount. Those who panic and sell now may miss the broader opportunity as the bull market continues to unfold. As we continue examining the silver market, it becomes evident that today's price movements are more about market mechanics than fundamentals. The COMEX margin increases, combined with leverage positions being liquidated, have created sharp drops. But these do not represent a true reflection of supply and demand. Physical silver remains tight, and the discrepancy between paper and physical markets is widening. This is a critical point for stackers to understand. The paper price may fluctuate violently, but actual metal availability is what ultimately determines long-term value. In the US, the futures market shows silver at around $71.50, while spot prices are hovering near $72.40. Meanwhile, Shanghai continues trading at a premium, around $82 per ounce. This divergence underscores the global imbalance between paper and physical silver. Asian markets have been absorbing vast quantities of metal, often at higher prices than the US, signaling strong underlying demand. The divergence is a warning to those relying solely on Western market screens. Real-world scarcity is far more pressing than short-term price swings suggest. Export restrictions, set to take effect in the coming days, will further tighten global supply. Countries like China and India are securing silver for industrial use and domestic consumption, reducing the amount flowing into Western markets. These measures are effectively creating a supply bottleneck, reinforcing the idea that paper prices may temporarily mislead traders. While US traders panic at lower numbers on the screen, overseas buyers continue to bid aggressively for the same ounces, maintaining pressure on physical stockpiles. Retail supply is another critical factor. Wholesalers in the US report delivery delays of 3 to 4 weeks, with many items completely out of stock. Some prominent bullion dealers are running low on both coins and bars, which suggests that actual metal is changing hands rapidly, even as paper prices fluctuate. This is the moment when true stackers have the advantage. They can acquire tangible silver at prices that may appear discounted on paper, but are still highly valuable in real terms. The volatility also serves to separate speculators from long-term holders. Those trading on leverage are forced out by margin calls, amplifying short-term declines. Long-term investors, by contrast, can view these dips as opportunities to accumulate more metal. This distinction is crucial for anyone serious about building a silver position. The market structure ensures that the weak hands are removed, leaving a stronger base of committed holders. Historical context further clarifies the current situation. In January-March 1980, silver's price reached $50 per ounce, then fell to $50 per ounce within a few months, a dramatic swing. However, the underlying factors driving demand, scarcity, and industrial use remained intact. Today's scenario mirrors that pattern. Short-term declines are amplified by technical factors, but fundamentals remain strong. The supply-demand imbalance, combined with growing global interest in physical silver, suggests that these drops are temporary corrections rather than the end of the bull run. Additionally, the current gold-silver ratio supports further accumulation of silver. With silver underperforming gold on a relative basis in certain markets, opportunities exist for investors to diversify their holdings and maximize potential gains. This ratio is historically significant, offering insight into relative value between the two metals, and today it indicates that silver may be undervalued relative to gold. In conclusion, the current decline in silver prices is driven largely by technical factors, margin adjustments, and paper market dynamics. Physical supply remains constrained, and global demand continues to rise. For stackers and long-term holders, this presents an opportunity rather than a warning. Those who panic and sell in response to short-term price drops risk missing the broader gains that the physical silver market is likely to deliver in the months ahead. Understanding the divergence between paper and physical markets, the role of international buyers, and the ongoing scarcity of tangible metal is essential for navigating this volatile environment. As we move further into the analysis, it's critical to highlight the impact of physical silver demand on the market. While paper markets fluctuate wildly, the tangible metal is being absorbed at an astonishing rate. Wholesalers and dealers are reporting that most inventory is being snapped up almost immediately. US delivery times are extending into weeks, and certain coin and bar types are completely out of stock. This real-world scarcity is driving the disconnect between paper prices and actual market conditions. The impact of margin hikes and leveraged positions cannot be overstated. COMEX has repeatedly raised margin requirements to control volatility in paper markets. While these adjustments may temporarily suppress paper prices, they do not affect the physical market. In fact, Each margin increase tends to push more speculative traders out, concentrating ownership in the hands of serious stackers. This process strengthens the base of long-term holders, while short-term speculators are forced to liquidate positions at losses. The result is a market that may look weak on charts, but is fundamentally sound in terms of supply and demand. Globally, silver's role as an industrial and monetary metal continues to grow. China and India are major buyers, both for industrial applications and strategic reserves. When US and European markets show weakness, Asian buyers often step in at higher prices. This is exactly what we're witnessing today. While silver in the West is trading around $72 per ounce, Shanghai is pushing toward $82. This premium reflects both scarcity and strong demand in physical markets. Traders ignoring international flows are essentially operating blind. The upcoming export restrictions will exacerbate this situation. Countries securing their silver supply are effectively reducing the available global stock. US buyers who wait for lower paper prices may find themselves unable to access physical metal. This highlights a critical point. In times of high volatility, access to tangible silver is more important than chasing short-term price movements. The metals that are immediately deliverable carry far more value than paper contracts that may not be fulfilled. It's also worth noting that the current gold-silver ratio favors silver accumulation. Relative to gold, silver remains undervalued in certain markets, especially when factoring in physical scarcity and industrial demand. Historically, this ratio has been an important indicator for investors seeking to maximize returns in precious metals. Those who understand it can make strategic purchases that position them for significant gains when the broader market corrects. Looking at historical patterns, we see that sharp corrections in silver are not unusual. The 1980 bull market, for example, saw prices rise to over $50 per ounce and then collapse to $15 per ounce within months. Despite this, the long-term trend favored silver accumulation, and the metal eventually resumed its upward trajectory. Today's price drop mirrors that behavior. It's a technical shakeout, not the end of the bull market. For stackers, these dips are buying opportunities, especially as physical supply remains constrained. The psychological aspect of market behavior also plays a role. Fear drives short-term selling, while scarcity and knowledge of physical demand drive long-term accumulation. Those who panic and sell are often the ones who miss the broader gains, while informed stackers strengthen their positions. This dynamic separates weak hands from committed holders and reinforces the market's foundation for future growth. In summary, silver's recent price decline is largely a technical adjustment driven by paper market mechanics and margin calls. Physical silver demand remains strong, supply is constrained, and international buyers are actively acquiring metal at premiums. The divergence between paper and physical prices highlights the importance of tangible ownership. For long-term investors, this is not a signal to sell, but rather an opportunity to strengthen positions. The fundamentals supporting silver remain intact, and those who act wisely during this period of volatility will be positioned for the next phase of the bull market. As we wrap up, it's essential to take a step back and view the silver market through the lens of both short-term volatility and long-term fundamentals. Today's decline in paper silver prices, while dramatic, does not reflect a weakening market. Rather, it underscores the tension between leveraged paper positions and the unyielding demand for physical metal. For serious stackers and investors, this is the type of environment where opportunities are born. The disconnect between physical and paper markets is reaching historic levels. While COMEX silver trades in the low 70s, premiums in Asia are signaling that tangible silver is far more valuable in real terms. This gap is a clear indicator of the underlying strength in the market. Those who understand this dynamic are actively acquiring physical ounces, knowing that when paper markets attempt to realign with physical reality, there will be significant price adjustments. Supply constraints are not going away. With export restrictions set to take effect in the coming days, global metal flows will tighten further. This will disproportionately affect Western buyers, who often rely on timely shipments from foreign mints and refineries. Any delay or shortage in delivery reinforces the concept that ownership of physical metal is more important than following paper market fluctuations. Simply put, what you can hold in your hand today may be worth far more in the coming months than what is listed on a screen. Historical patterns show that these corrections, while steep, are temporary. Major bull runs in silver are often punctuated by short-term shocks that appear catastrophic to the unprepared. In 1980, prices surged to $50 per ounce and then collapsed to $15. Yet, over the long term, silver continued to recover and exceeded previous highs. Today's sell-off is reminiscent of that scenario, a necessary shakeout that clears weak positions and strengthens the market foundation. Those who panic and sell are likely to miss the next leg of gains, while strategic accumulation during this period will pay dividends. Psychology is a critical factor. Public fear, fueled by dramatic headlines and market charts, drives emotional selling. Meanwhile, informed investors who recognize the scarcity of physical silver continue to buy, reinforcing the upward pressure over time. This natural separation between weak hands and committed stackers is an essential mechanism in the market, ensuring that the metal ends up in the hands of those who value it most. For anyone watching, this is a reminder. Volatility is not a signal to exit, but an opportunity to deepen your position. Prices may fluctuate in the short term, but the long-term trend for silver remains bullish. Physical scarcity, industrial demand, and global accumulation by Asian buyers create a structural backdrop that supports continued appreciation. Today's paper market dip is a tactical buying window, not a fundamental weakness. As we close, keep your focus on tangible ownership. Secure what you can now while the system is operational and supplies are still accessible. Monitor global flows, pay attention to premiums in physical markets, and be prepared for the next phase of the bull run. Remember, silver is not just a commodity. It's a store of value, a hedge against currency devaluation, and a critical industrial metal. Those who understand this distinction and act decisively will emerge stronger when the market rebalances. In conclusion, while the recent price drop may feel alarming, it is a short-term event in the context of a broader bull market. The fundamentals remain intact. The demand for physical metal is robust, and international buyers continue to drive scarcity. For stackers and investors, this is the moment to focus on acquiring real silver, not chasing paper trends. Stay disciplined, watch the physical market, and remember, volatility creates opportunity. Those who act wisely now will be well positioned for the next phase of silver's journey.